All right. Today is Wednesday, July 13th. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. Happy French Fries Day. Another excuse to be a slob, and I'll take all of these days. No problem. Until the heart attack actually happens. In the meantime, yeah. Happy CPI Inflation Day. For a moment there, I thought this is a cooking channel. What a disaster that was. So let's talk about it. And here it is. In focus tonight. An epic disaster. All of these calls for peak inflation. It didn't happen. Inflation exploded higher again. Here it is. U.S. inflation reached 9.1% in June, the highest rate in nearly 41 years. Congratulations. Congratulations to the Fed. You're almost there. You're almost there, Jerome Powell. Get it to 10%. Let's do it. Come on. Now look at this. 9.1% in June. We're getting closer and closer to the insane inflation back in the 1970s/80s. And even if you exclude the not important, of course, food and energy, maybe oxygen too, the inflation rate is still at a stunning 5.9% year over year. Month over month, everybody thought that this is peak inflation. Who cares about year over year? It's all about month over month. Guess what? They got served massive pies right in the face because month over month, the CPI is up 1.3%. Even the core CPI was up month over month by 0.7%. Unbelievable. Inflation is out of control right now. And if you think this is peak inflation, think again. And even if it is, right now, the concentration is not going to be about peak inflation or not peak inflation. The concentration will shift into the sticky inflation or not sticky inflation. We all know it's going to be sticky. Look at core CPI. It is at 5.9%. We all know that rent inflation continues to move higher. This is an epic disaster for the Fed, and it will require more aggressive action when it comes to the monetary policy, which means we're all gonna feel the pain. If you thought that what you've seen so far is it, buckle up your seatbelts, baby. It's about to get really rough. The inflation rate year over year for gasoline is over 60%. For airline fares, it exceeds over 30%. For new vehicles, the inflation rate is above 10%. For food, a stunning over 10% year over year. And you know why we call it the CPI? Because look at rent, for example. They say, the CPI, the cooks at the bureau, they say that year over year, the inflation in rents went higher by about 5.5%. Not a big deal. Come on. Meanwhile, you and I know that inflation in rents is exceeding 100% in certain instances. And if rent inflation was calculated in this formula, the inflation rate would have exceeded 20% for all items. But regardless, it's all about the month-over-month reading, right? The peak inflation crowd, well, look at this. Food, month over month, is up 1%. When we talk about energy, that's up 7.5% month over month. And then we have gasoline up over 10% month over month. You got electricity, that's up 1.7% month over month. And utility for gas, unbelievable, up 8.2% month over month. And it goes on and on. Even for transportation services, it went higher by 2.1% month over month. Medical services, up 0.7% month over month. So again, inflation is not stopping. It continues to move higher. Yes, we will see fluctuations up and down month over month. And perhaps the reason behind the rebound in the equities market today is the fact that folks are saying the major contributor to inflation rising higher month over month is energy, specifically gasoline and utilities for gas. But all of these commodities went down big in the last couple of weeks. We're seeing prices at the pump going down. We're seeing utility bills going down slightly. So perhaps this is peak inflation. This is the top in inflation, and higher we go in stocks. We're out of the woods. Again, whether this is peak inflation or not peak inflation, what really matters right now is how sticky it is. Sticky, that's the key word. For example, today we got earnings, a disastrous report from Delta Airlines. Their revenues are rising higher significantly year over year, and the reason is they're charging more per ticket. You're paying an arm and a leg to fly. But the problem is their expenses, the jet fuel, wage inflation, caused their earnings to go down. This is unsustainable for the airlines, so they have to increase prices even further. What is that going to do? Well, airfare ticket inflation will move higher, and that will push the CPI also higher. So yes, you might get a relief from gasoline next month, but the problem is you got airfare tickets moving higher, you got transportation costs moving higher, and oh, by the way, you got rents moving higher. That's lagging. It takes a few months before it shows up in the CPI. And even with the cooking, rent inflation is absolutely stunning. Look at this. It continues to move higher and higher and higher. Is this peak inflation? Of course not. We all know that rents went higher last November, last December, in January, in February, all the way so far this year. Rents have been moving higher and higher and higher. And in last night's video, I explained to you in details why higher mortgage rates will lead to higher rent inflation. Go back and watch that video. So the peak inflation crowd, be careful here. You might get a relief in gasoline, but you got rents, and that counts a lot in the CPI. Matter of fact, the owner's equivalent rent, this is the cooking, of course, OER, portion of the CPI continues its uptrend. 5.5% annual increase, the strongest since September of 1990. Does this look like peak inflation? Of course not. But rest assured, you got the BlackRock administration. They got the solutions, baby. They got this inflation under control. Maybe a few more years, maybe a few more centuries, and they'll get this inflation under control. Listen to the BlackRock administration representative, Brian Deese. Take a look.
Well, look, a couple points on today's report, as you just said. The first is, it's backward looking, and it doesn't reflect what we've seen over the last 30 days, which is a significant decline in gas prices, down about 40 cents. That June report, about half of it was driven by energy prices, and we've seen moderation since. But the second point is that in the core, inflation remains too high, which is why we need action. And I just want to underscore, if there's one thing to take away from this report, it's that there is more urgency now than ever in Congress moving to pass a bill to try to build more domestic semiconductors, to try to bring down the price of those goods. You see across this report things like used cars and new vehicles, those prices holding up. That is not principally driven by demand. It's driven by supply and constrained supply. We know how to solve that. We should have solved that months ago, but we now have a moment. We need to do that. If there's any takeaway from this report, it should be that.
Now, this lunatic, you wonder why the economy is in shambles? It's because these kind of creatures are leading the economic policy of this country. His solution to higher inflation is higher inflation. Let's keep spending more and see what happens. The demand is out of whack. His solution is, let's spend more to make the supply catch up with this insane demand in the economy. Two problems with that. Number one, if you're going to spend more to build factories, to ramp up the supply chain, well, guess what? We got a labor shortage. Number one, which means wage inflation will go higher. Number two, you're spending more, which will cause more and more and more inflation. And point number two, the problem with this approach, is the fact that this stagflation, whether it prolongs on its own and destroys the economy on its own, causing a recession, or whether we're going to have a recession induced by the Fed's policy of raising interest rates aggressively, just like we got back in the early 80s under Volcker. In either case, the demand, this insane, absurd level of demand, will get crushed down. Unemployment will rise higher. If you're spending more right now to ramp up the supply chain to match an insane level of demand, you're going to end up with a different dynamic, perhaps more destructive dynamic in the economy, with supply surpassing demand. This is going to be a major, major problem. But these are the genius ideas that we get from the BlackRock administration. Unbelievable. This guy should be fired immediately. This guy's not even qualified to be dog catcher. He cannot even fix a cup of coffee correctly, but somehow he's leading charge of the economic policy of this country. Come on, man. Get your facts straight, Jack. And by the way, Brian, when you see the small business, the pain in small business, we covered the Small Business Optimism Index last night. Here's another one. Small businesses continue to report pain from higher prices, as you can see. The highest reading in record. Tell me how ramping up the supply chain will alleviate the problem that these small businesses are facing. How is spending more going to fix wage inflation? We know that the higher inflation goes, the more pain small businesses feel in the country. Large enterprises, the Amazons, the Walmarts of the world, they can cope with higher inflation. Maybe they can lose money here and there when inflation gets way too high, way too fast. There is a limit after all. Yet the majority of the economic pain is felt by small businesses, the backbone of this country. And here's the problem. We got a hotter than expected, at least on face value, employment report on Friday, and now we got a hotter CPI reading. What does that mean? The Fed is way behind the curve once again. They need to be more aggressive. And expectations, the odds for a 100 basis points increase went significantly higher today for the July meeting. In the morning, the odds for a 100 basis points hike went from 3% to 28%. And later on, they went higher to 43%, if not beyond that. This is a disaster report, as Jim Bianco says, and you could play this cute game that this is peak inflation and the Fed has to back up at some point and start easing again. That's all a fantasy. Watch how even core CPI is going to stick, and the Fed will have to be more aggressive over and over and over again. They're not going to see the results till next year. In the meantime, they have to do that because if they tell the public, hey, we have a lagging impact, we're afraid of overdoing interest rate hikes, that's not going to work because there is something called inflation expectations. The Fed is now in a trap. They have to continue and respond by aggressively increasing interest rates higher to tame down inflation expectations, even at the cost that these aggressive interest rate hikes will show up next year and will damage the economy tremendously. But you gotta kill the inflation monster, and they cannot do that without taming inflation expectations. This is a dangerous, dangerous game. But here's the point. Now the Fed has the unemployment cushion, at least for now. So the economy, theoretically speaking, at least for now, can absorb the shock of aggressive interest rate hikes. So do it now. You know that to tackle inflation, you need to bump up the Fed funds rate above the CPI. I'm not saying get it above 9.1% for all items. I'm just saying get it above the core CPI, which is 5.9% right now. And not even that. I'm saying just get it to 5%, Mr. Powell, because you know you're going to have to get it to 5% sooner or later. But if you wait, the economy will be damaged and you're going to increase interest rates on a wounded economy. But if you do it right now, the shock and awe approach, number one, the economy, theoretically speaking, has the cushion to absorb the shock, at least for now. Number two, you get the benefit of taming the inflation monster. The shock and awe is necessary right now. Look, for example, at the Canadian Bank, the Bank of Canada, which did their own mini version of the shock and awe by increasing interest rates by 100 basis points today. And even that's not going to be enough. 100 basis points by the Fed is not going to be enough. We're talking about 300 basis points, baby. That's the shock and awe that is required right now to take inflation out of the equation, while the economy still has some cushion. If you wait for later, you're going to damage the economy tremendously. But do you think the Fed even understands what I just said? Of course not. They're a bunch of zombies. They're only honest when their opinion doesn't really matter. For example, the Atlanta Fed President Boystick, he came out today and said, let's do 100 basis points. But he's not a voting member. What's with the aggression all of a sudden, Mr. Boystick, now that you're not a voting member? He's just trying to wash his hands clean. This is not my responsibility. I've been arguing for 100 basis points. I've been arguing for higher interest rate hikes. Not my problem. This is what he's doing right now. This is Boystick. Remember the game? Let's join the game. That's who Boystick is. And they're all lousy. All of them. No exceptions. And the problem right now is the probability for recession is increasing higher and higher by the day. Look no further than the yield curve inversion. This is the worst inversion in over 20 years. Even in the height of the yield curve inversion before the Great Recession in 2009, we did not see the yield curve inversion reaching this magnitude. What does that mean? This recession will be very, very deep and painful if this trajectory continues. Matter of fact, a lot of folks today, forget about 2023. Today, they believe that the economy is already in a recession. Why? Because the poor, the lower middle class, even the middle class are now feeling the pain. They're actually in a recession. Inflation is too high. It crushed their budgets. They might have a job. They might have an income. But all of that income is being wasted on higher rent, gas at the pump, food at the grocery store, utilities. And at some point, the paycheck is not going to be enough to pay the bills. Therefore, we have, among all voters, 65% of Americans believe that we are already in a recession. Among independents, 65% say that we're already in a recession. And by the way, back in March 2020, when the economy was actually in a technical recession, only 47% of independents believed that the economy is indeed in a recession. Now we're talking about 65%. Unbelievable. Even among Democrats, 53%, the majority, believe that the economy is right now in a recession. And a stunning 78% of Republicans believe that the economy is already in a recession. Unbelievable. And here's the last take before we move on. And it's an important take. Pay attention now. For the so-called peak inflation crowd, we're out of the woods. The economy is going to improve again. The stock market will blast higher again. Be careful what you wish for. For example, yes, used cars and truck prices were up 7.1% year over year. This is the weakest gain since August 2020. And as you can see, used car/truck inflation is moving down indeed. But here's the problem, or problems. Problem number one is the sticky part. Remember sticky? For example, used cars prices right now have a premium of over $10,000. So the same car, used car, if you bought that car 2 years ago, you bought it at around, let's say, $21,000. That was the average for a used car. Now the average for a used car is over $30,000. We're talking about used, folks. Yes, the inflation in prices might be peaking, but how sticky will it be? That's problem number one. Problem number two, is used cars inflation going down for the wrong reasons? For example, a recession? The answer is perhaps, and most likely. So if you see gasoline prices moving down, the inflation in those prices moving down, you must ask the question, is inflation moving down for the good reasons, meaning supply all of a sudden magically appeared? Or is it moving down for the bad reasons that a recession is happening? For example, the headline reads, car repos are exploding. Uh-oh, that's a bad omen. What are they talking about? Lucky Lopez is a car dealer who has been in the business for over 20 years. In recent meetings with bankers where he bids on repossessed vehicles before they go to auction, he has noticed some common characteristics of the defaulted loans. Most of the loans of the recently repossessed cars originated during 2020 and 2021, whereas origination dates are normally scattered because people fall in hard times at different times. The loan-to-value ratios, or the amount financed relative to the value of the vehicle, are around 140%. Wow. Versus a normal 80%. And many of the loans were extended to buyers who had temporarily pops in income during the pandemic, aka the stimmies. Those monthly incomes fell, sometimes by half, as pandemic stimulus programs stopped. And now they look even worse on an inflation-adjusted basis, and as the prices of basics, in particular, are climbing. This is a disaster. Folks thought that they're getting rich. All of a sudden, the government is printing trillions of dollars, handing stimmies all over the place. They got eviction moratoriums. You don't have to pay your rent, and you got all kind of benefits all of a sudden to compensate you from damages from the thing. And folks thought they're getting rich. They went on splurging, getting mortgages they cannot really afford, getting car loans they cannot really afford. Fast forward, the stimmies are gone, the benefits are gone, you gotta pay your rent all of a sudden, you gotta pay your bills all of a sudden, and oh, by the way, inflation is moving higher, interest rates are moving higher, and you might have lost your job. All of a sudden, a lot of folks are in the hole. Yet they got car loans, they got mortgages, they got credit card debt, and the interest rate on that is moving higher. You think the government or the taxpayer is going to bail all of these people out? Maybe, if the last name is a corporation, but besides that, it's not going to happen. This is an epic disaster in the making. Continuing, part of the problem is that some consumers' incomes were temporarily high as the pandemic brought about debt forbearance, pandemic stimulus checks, enhanced unemployment benefits, and in some cases, forgiven loans from the Paycheck Protection Program. Lopez says he recently bought a Bentley, McLaren, and 2 Aston Martins, all purchased by buyers using PPP money as down payments. Wow. Talk about fraud. And all repossessed after few or no monthly payments at all. And remember how they say this time is different because the folks who are getting car loans and insane mortgages have excellent credit scores. Don't worry about a thing. This is not 07, 08 all over again. Well, here it is. Another recent acquisition, a Silverado, repossessed from a borrower with a solid 700 credit score who made 2 payments. Now he says, this is Lopez, that he has never seen so many people making $2,500 a month, owing $1,000 a month in car payments. You want to talk about insanity? Here it is. That is about double the maximum portion of income many financial advisors recommend allocating toward a car payment. The idea that the economy is strong Question mark. Anyone who's actually doing business sees things are not strong. Surprise, surprise. We had a housing bubble in 2008, and now we have an auto bubble. The problem is, how contagious is it going to be? You get your car repossessed. What's next? Your home foreclosed? All of these so-called remote workers who have jobs in California, yet they got mortgages to buy homes in Iowa because it's cheaper. What happens when you lose your job? All of a sudden, these people got to compete on the 10 jobs left in Des Moines. Folks, the economy is a lot weaker than we've been told. The risk-taking is a lot more aggressive and insane than we've been told. This is a recipe for a disaster. As the Fed continues to increase interest rates higher to tame this inflation, what do you think will happen? But of course, what's up with the FUD, bro? What's up with the negativity, right? Let's end on a positive note here. If you've been listening to me for the last, 10, 20 minutes or so, and you shit your diaper and you're about to have a heart attack, not from National French Fries Day, but from the information I just presented to you, rest assured, maybe you don't have to worry at all, because what if the Fed doesn't have to increase interest rates higher? What if the Fed says, you know what, we're moving our inflation target higher from 2% to 4%, or maybe 5%. 5% inflation is normal. Live with it. Deal with it. Because God forbid stocks and real estate values move down, aka the assets of the rich. We cannot handle that. They're too big to fail. So all of you poor, middle class, the bums, buck up and take a 5% inflation rate. It's not a big deal. Come on, man. See, a lot of you, the perma bulls, the pumpers, and the likes, say that the Fed will reverse course. They will start easing the monetary policy at some point. They're going to start cutting rates. Maybe, but the most likely scenario is they're going to upgrade their inflation target from 2% to 3%, 4%, 5%, how about 10%? That's the new normal, right? Anyways, we're going to move on here, folks. We had a stock market to cover, and we start with the performance of indices today. And here we go. The Dow Industrial Average closed down by 208.54 points, or a decline of 0.67%. The Nasdaq down by 17.15 points, or a decline of 0.15%. The S&P down by 17.02 points, or a decline of 0.45%. The sector's performances led by cyclicals at number 1, capturing the gold medal, number 2 for the silver, energy, number 3 for the bronze, materials. The laggards of the day led by communication services, industrials, and financials. All of a sudden, energy and materials are making a comeback. We'll see how long that lasts, but is this an indicator that perhaps the inflationary trade is making a comeback? We'll see. What about the advance to decline ratios? NYSE 50% advancing versus 46% declining. NASDAQ 50% advancing versus 44% declining. Moving on to commodities. What's going on here? Muted action for crude. The WTI and Brent, we're waiting for what? We're waiting for Saudi Arabia. Whatever Joey B gets or doesn't get will move crude futures significantly, one way or the other. And the assumption is, if it is no deal, if the Saudis don't have the capacity to increase production right now, or maybe they're not interested at all, we will see a massive rebound in crude futures. But if there is a deal, it depends on how big it is, because a lot of that has been already priced in. So pay attention here. Perhaps we have a rebound trade in crude. We'll talk in the charts analysis. But gasoline, the RBOB was down almost 1.25%. Heating oil was flattish, slightly in the green, while natural gas led the gains today, rebounding significantly higher with gains of over 7%. What about softs? It was a down day once again for cotton futures. Forget about the rebound. The short covering is done for now, and cotton futures went down by over 3.5% today alone. And then we have sizable declines for OJ and cocoa futures, all down by more than 2%. Yet we have some gains. That counts, right? For coffee, for lumber futures, and notable gains for sugar futures, scoring gains of about 2.5% today. Metals, rebound day, not by a lot, but that also counts. The dollar showed some weakness today. Perhaps it is peaking, not peaking, who knows? But that was good enough for gold, silver, platinum, copper to move higher. On the other hand, palladium continues to decline. Yesterday it was down big, over 6%. Now it's down again by over 2%. What about meats? Muted action, be it in the green for live and feeder cattle futures. Here it is, the new big tech holding gains and scoring more gains on top of that. Today, lean hogs futures scored gains of about 1.5%. What about grains? Mixed picture here. We have declines in soybean oil futures down by almost 2%, oats down by almost 1%, rough rice, wheat, all flattish, be it in the downside. Yet we have a rebound in soybeans, soybean meal, corn, and canola futures continue to build up on the gains. Moving on to the big casino, the options market, what's going on here? The volume went down all of a sudden. What does that mean? Indecisiveness. We need time to absorb the CPI. Folks assumed, at least today, that this is peak inflation and therefore the Fed may be talking tough, but they're not going to do it. But we need more time to think. For all you know, we wake up tomorrow in the morning and the futures are down 2, 3, 400%. Points. Why? Because all of a sudden, the market realized that maybe this is not peak inflation and the Fed has to increase interest rates aggressively either way to tame inflation expectations. And therefore, we're not seeing a significant level of commitment in the options trades that we got today. Regardless, Apple came up number one, the hottest table by far, at around 1 million contracts traded today. About 51% of those were calls. And number two, Amazon. I still have calls. Those scored big today, because I bought in the dip. Amazon traded around 700,000 contracts today. About 49% of those were calls. Number three, Tesla, the souffle, at around 600,000 contracts traded today. About 48% of those were calls. Moving on to the unusual activities that took place in the casino today. We start with the ticker CHWY, Chewy. The name is beaten and bruised, and somebody's betting for more pain to come. They bought the 37.5 puts for the expiration date, July 22nd, with expectations that Chewy could go down by more than 12.5% by then. They paid around 75 cents apiece to enter this trade, all in all spending around $750,000. And then we have the ticker BA for the flying coffin, Boeing. They continue to bid this name higher, lots of short covering, and they're betting for more gains to come. Somebody bought the 155 calls for the expiration date, July 22nd, with expectations that the BA flying coffin could score more gains, worth over 7.5% by then. They paid around $1.20 apiece to enter this trade, all in all spending around $700,000. What about the QQQ, the Nasdaq? What's going on here? They're buying puts, fading the rebound that we got today, buying the 260 puts for the expiration date, August 1st, with expectations that the Qs could go down by more than 9% by then. They paid around $1.60 apiece to enter this trade, all in all spending around $800,000. And then we have the ticker FSLR for First Solar. Somebody's bidding for the name to go higher by buying the 75 calls for the expiration date, August 19th, with expectations that the name could move higher by more than 9% by then. They paid around $2.80 apiece to enter this trade, all in all spending around $700,000. And lastly, we have the ticker OIH. This is for the oil and gas ETF. Somebody's buying calls, betting that perhaps no deal in Saudi Arabia, and therefore we will see a rebound across the energy sector. They bought the 230 calls for the expiration date, July 29, with expectations that the OIH could rebound higher by more than 11% by then. They paid around $3 apiece to enter this trade, all in all spending around $750,000. Moving on to the heat map analysis, what's going on here? We got a mixed picture across the board. For example, Alphabet is moving down big, and the reason is yet another company, in this case Alphabet, is announcing freezing hiring and perhaps cutting jobs pretty soon. Yet we have chips trading in the green, led by TSM Taiwan, because we have the government over there funding TSM. Can you buy based on that news or not? I wouldn't, because you heard Brian Deese talking about the CHIPS Act, which is another money laundering scheme, by the way. But regardless, if we build our factories right here, TSM goes down in the trash. And then we have weakness in financials, yields are down. We have more and more recession expectations, more default expectations. You heard the repos in car loans, and tomorrow we're going to get earnings from GPM, JP Morgan, and Morgan Stanley, I believe. We'll see how they do. And then we got a lot of weakness in healthcare, specifically in the health insurance plans. UNH down big, over 2.5%. In industrials, even the defense contractors were down today. Raytheon was down over 2%. Lots of weakness in industrials. Look at FedEx down big. When we talk about energy, we're seeing some rebound. Likewise, in materials, we're seeing some rebound in the agricultural names, in steel. Is this the beginning for revival of the inflationary trade? I gotta see it to believe it. What's working right now, regardless? The answer for now is consumer staples. Names like Procter & Gamble, names like General Mills, names like Kellogg. They continue to move higher, slowly but surely. They withstood the inflation storm, and they will do a lot better than the rest of the stock market, at least, under a recession. Then in cyclicals, we have Amazon scoring gains and bucking the trend of the big caps, maybe because I bought calls. See how that works? And then we got Tesla also moving higher. Did not buy calls on that one, but so did a lot of EVs such as Li Auto, NIO, perhaps on the news of Walmart's acquisition of Canoo. Not acquisition, but they're buying a bunch of cars, that kind of revived some energy in the EV arena. The cyclical names, the reopening names, some of them are moving higher, but again, this is a mixed picture. We're not going to make any major decisions, major trading decisions based on this. We got to absorb and see how the market reacts all the way till the end of the week. What about the heat map for the ETFs? The notable action is the mini rebound for now in commodities, specifically in UNG, natural gas, in gold, in silver, in certain oil and gas ETFs. The XOP, for example, was trading higher today. So did materials, the XME. So again, is this the beginning of the revival, the inflationary trade? But we have the XBI, biotech, continues to move higher again. So we have mixed signals here because the XBI indicates growth, risk on, deflationary should move higher, not inflationary. This is a battle for now. It's going to be sorted out. And you don't want to be caught in this process. Don't make any significant bets until we know what the shot is. For now, we got the knee-jerk reaction based on the CPI, the digestion, the absorption. That will present us with the real reaction of the stock market from this CPI. But perhaps the charts can offer more clarity than the heat maps, so let's do that. We start with SPY. 30 minutes chart, what do we see here? We got the gap down, the head and shoulder formation that we talked about last night, played out in the morning. We got the gap down, but here comes the dip buyers based on peak inflation, short covering, whatever it is, doesn't matter. We got the pump higher, not only closing the gap, but trading in the green, at least briefly. But at the end of the day, the SPY closed below the gap, which happens to be at around 380.22. Is this a big deal for now? The SPY did not close above the gap? Not really. But here's the risk. If we remove some of these markings, what if this is an ABC pattern? We got the A leg, and today we formed the B leg, and perhaps tomorrow we're getting the C leg all the way down to the support of 373.5. The bulls will counter and say, all of that is cute, but if the SPY wanted to go down, today was the perfect day. You got a hotter than expectations reading the CPI. Why didn't the SPY go down? Why did it actually rebound higher and closed at the highs of the day? This is a sign of strength, not weakness. Both arguments are persuasive, but perhaps the daily chart can present a winner here. Here's the daily chart for the continuous contract for the SPY. The point for the bulls is the higher lows. For now, the chart is still showing higher lows. The problem is, if by tomorrow, for example, the chart goes down, forming a lower low, and better yet, losing the support of 3,720.5, then we know for sure the bulls are done. Here comes the bears back in charge. Now, we're not making a big deal about the surge in volume, and the reason is, it was CPI day. It is expected. We cannot make any conclusions one way or the other based on the spike on volume in the CPI day. But what about the momentum indicators? They're weakening, they're curling down, they're not showing us any negative readings yet in a confirmation that the bears are coming back. But the bulls must push this chart higher by tomorrow, forming the higher low. Otherwise, the bears will creep in. You will see the support being lost. You will see the MACD indicator moving down, showing a red impression in the histogram, indicating the end of the rebound and the beginning of the formation of a lower low. What about the Qs? 30 minutes chart for the NASDAQ. What's going on here? We got the gap down big time in the morning, losing the support of 285. But here's the good news for the bulls. The dip buyers showed up. They got the chart above 285 and they closed the day above 285. I would say this is a win for the bulls. Is it in the bag? Not really, because what if this is another ABC pattern? We got the B leg today. Soon enough, we'll get the C leg, perhaps by tomorrow, and the support of 285 will be gone. What about the daily chart for the continuous contract for the Qs? For now, the bulls are in charge because they're still holding a pattern of higher lows, number one. Number two, the support of 11,689 remains intact. Number three, the momentum indicators for now remain bullish, but they're weakening. We're not going to make a big deal about the volume, as I said with SPY, but the bulls must show up by tomorrow, maximum by the end of the week. And they must not lose the pattern of higher lows. They must not lose the support of 11,689. What about the IWM, Russell 2000, 30 minutes chart? What's going on here? Similar with SPY and the Qs. Here in the IWM, we got a gap down all the way to the support 168.90. The chart caught support from that critical point and it rebounded higher, closing at the highs of the day. Yet it faced some resistance at around 172.25, which is a previous gap. Is it the end here? Is it a rejection? We're not going to say that for now. The risk remains that this is an ABC pattern, just like we talked with SPY and the Qs, be it looks a lot weaker here. It looks like the bulls have the better argument here. And if you believe that the IWM is a leading indicator, then the bulls are also in charge in the Qs and the SPY, even in the 30 minutes charts, and the ABC pattern will not happen. So the Russell supports the bulls, and you will see other indicators also supporting the bulls. Chiefly, and most importantly, the Dixie, the dollar index. This is an hourly chart, or excuse me, a 30 minutes chart. Look at this. The Dixie popped higher initially in reaction to the CPI, was a knee-jerk reaction, and then it reversed the entire move, forming what it appears for now a bear flag pattern. And I tweeted right before the open saying that the only way for the market to reverse today is for the dollar to magically trade lower somehow. Well, it did that. Exactly. We got the rebound. But both moves, the reversal in the Dixie and the rebound in the Qs and the major indices, is not decisive yet. All what we got today is the SPY and the Qs going back pretty much to flat, and the Dixie reversing the move and going back to flat. It's a tit for tat. Who's going to win? Who's lying? Who's bluffing? Well, here's the daily chart for the Dixie. We know the Dixie is overextended. So which one is at the risk of continuing the move that we got today? Is it the Dixie moving down, or is it the Qs moving higher again? Looking at the daily chart, the probabilities say that the Dixie sooner or later will move down. Why? Because the momentum indicators are getting really, really overextended. We have what it appears for now, yet another potential, keyword potential, reversal candle. We need a confirmation. Once we get the confirmation, guess what happens? Not only the equities market will blast higher, but also gold. Gold popped higher today. Initially, it went down big, but it reversed as the dollar was reversing down. Is this a beginning of a rebound rally in gold? I think so. It is way oversold. It should at least catch an oversold rally, and the dollar should catch an overbought pullback, which should be good news for the equities market, but wait and see. What about crude? 4 hours chart for Brent. What's going on here? We talked about the double bottom. For now, it's a wait and see. Whether the double bottom will work out or not, it depends on the news from Saudi Arabia. For now, we cannot do anything about it at all. But is the risk for this chart to move higher or lower? Looking at the 4 hours chart, I would say the risk is for a move higher, because the chart moved down big in recent weeks, perhaps in anticipation of the visit to Saudi Arabia, and it is becoming slightly oversold, so the risk is to the upside. What about the 10-year yield? What's going on here? We got a hotter than usual CPI, 9.1%, yet yields kind of flattish. I would not say with confidence, looking at the action right now, that yields will move down. Because what does that say in English? What does that mean if yields move down in reaction of a hot CPI? That says lower growth expectations, aka a recession, aka more inversion of the yield curve. But if yields pop higher again, what are they saying? They're saying that there is no peak inflation. Inflation is moving higher. The Fed has to raise interest rates aggressively. We're seeing growth kind of intact along with inflation, at least for now. Inconclusive, even though the chart lost 3% for now. Keyword for now. The RSI, the MACD are kind of supporting a move higher in the 10-year yield. But I would say inconclusive looking at the chart and at the pattern right now. But rest assured, here's what's conclusive. The TLT weekly chart. This is going to move higher sooner or later. It got way oversold and it's going to pop higher sooner or later. What does that mean? Yields are going down. Perhaps on a recession expectations, maybe bonds, in this case TLT, will move higher, also based on recession expectations, as folks continue to buy bonds as a resort for safety. Now, would that be good for the equities market? Not really. Maybe in the short run, a dump in the dollar will pop equities hand in hand with the TLT. But if the TLT continues to move higher aggressively and yields continue to crash and we see more inversion in the yield curve, rest assured, whatever bounce we get in the equities market will not last. But for now, for the TLT, is it wise, from a technical perspective at least, to go long in the TLT for now, at least via call options? The answer is, it's not a stupid bet. It is actually what technical traders would do. The fundamentals, that's a different story. But from a technical perspective alone, this chart should move higher. The VIX 4 hours chart, what's going on here? It popped higher above 28.16, then it lost that support, and it closed pretty much at the lows of the day. Look at the MACD indicator. It is weakening, but do we have red impressions in the histogram indicating that the VIX is turning negative, and therefore the SPY should continue to move higher? Not for now. Keyword for now. The VXN, the VIX for the Nasdaq, different story than the VIX. We're seeing the beginning of positive momentum on the MACD indicator. Is it conclusive? Is it strong enough to say that the VXN will move higher, the Qs will move down? Not really. But by tomorrow, as soon as tomorrow, we could get an answer to that. But I'll be watching 32.72. If that support is lost and the VXN gives us a confirmation that this support is gone, you'll know that by a follow-up candle, at least from a hourly perspective, then you'll know the Qs will move higher. And the pop that we got today, the rebound has more juice to squeeze. Apple, a daily chart, what's going on here? Yesterday's candle was kind of a reversal candle. We're waiting for the confirmation. We got the confirmation candle today, but by the end of the day, that confirmation was gone. Why? Because the chart closed at the highs of the day, and it managed to recapture 145 as support, at least for now. So we got a repair job in Apple, and as Apple goes, so will the Nasdaq. For now, if Apple keeps 145 by tomorrow, then the rally will go on for the Qs. Tesla, 30 minutes chart, what's going on here? Just like Apple, we got a gap down in the morning, but the dip buyers showed up right away, and now the chart's trading above the critically important 700 level. But for now, the likelihood of a retest to 700 is highly likely. If you're a bull, you want to see a retest of 700 and a rebound, better yet a close at the highs of the day from that rebound. If you're a bear, you want to see a test to 700 and a failure that will initiate a shorting trade, indicating lower lows to come. What about BTC and hourly chart? What's going on here? We talked about the importance of 19,550. For now, Bitcoin closed above that number, at least for now. But this is a continuous trading chart, so anything goes. If the chart loses that support once again, it would be a confirmation that the chart doesn't have what it takes to move higher. What does that mean? Lower we go. That bear flag on the daily chart will play out and we will see Bitcoin flushing down. But if this support is held, then the next challenge would be 20,450. Breaking above that will be extra bullish, indicating risk on. That will be good for Bitcoin, but also good for equities. And lastly, let's move on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have the most important PPI, the Producer Price Index. If that comes out way too hot, I don't think the market is going to like it because the PPI is a leading indicator for the CPI. We also have another important indicator, which is initial jobless claims. We have one of the most hawkish members of the Fed, at least recently, Governor Waller. It'll be interesting to hear what he has to say after the CPI, but also after the PPI reading. All of these are market-moving events, the PPI, initial jobless claims, and the remarks from Waller. So buckle up your seatbelts. We got a lot of action coming. But with that, I'm done here. This is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.